Good afternoon, everybody. My name is Charles Moore. I'm the founder and president of the Bank Funds Company, the moderator of, our panel, and one general partner in this group of limited partners. I also participate in Fund Managers Without Borders. Last night, in a fit of daring, I crossed the Illinois-Indiana border, forded the Hudson River, and made it all the way to New York City. To prepare for this panel, Bank Fund 9 has been fundraising for 5 months. Of course, it seems like 5 years, but I'm sure that's just my imagination playing calendar tricks on me. Our topic today is middle market fundraising, which we will approach from 4 vantage points: how funds differentiate themselves, how managers size their funds, how middle market competition is playing out, and then we'll look at general funds versus focus funds. We are fortunate this afternoon to have a panel of very experienced limited partners steeped in private equity and middle market. The panelists will each introduce themselves, so we'd like to begin with Whit Matthews.
Great, thanks, Charles. Whit Matthews from SL Capital Partners. SL Capital is the private equity fund-to-funds business of Standard Life Investments. Standard Life is a Scottish-based asset manager, which has its own unique issues today, given everything that's going on in the world. Our focus is on the European market and the North American market from a private equity perspective. We tend to focus primarily on lower middle market buyout-oriented opportunities. We're active on a primary, secondary, and direct basis. I am one of 3 folks based in Boston, focused on the North American market, with the vast majority of the rest of our team based over in Edinburgh.
Great. Arslan?
Hi, I'm Arslan Mian with BlackRock Private Equity Partners. I co-head the co-investments business and co-head of Americas. And just like Whit here, we're focused on fund investing, co-investing, and secondary investing. Our total AUM just in the private equity business today is close to $19 billion. And BlackRock, I'm sure you guys have heard, is a $4 trillion asset manager. So we are one of the smallest businesses. As funny as it may sound, at $19 billion, one of the smallest businesses within BlackRock, but focused a lot, as Whit said, on the middle market, investing both directly as well as fund investment.
Thank you. Ian?
Great. I'm Ian Rice. I'm from Hartford Investment Management. We're the asset management arm of Hartford Financial Company, an insurance company, and our overall portfolio is about $115 billion, of which alternative assets is about $5 billion. $2 billion of that is the private equity program. We're focused on U.S. middle market and lower middle market buyout funds, and our average investment size is kind of in the $10 to $30 million range. We're looking at funds $100 million to $1 billion.
Wonderful. Our company is the Bank Funds. We are the leading investor in small U.S.-based financial service companies. We focus on community banks, but we also do regional stock brokerage companies, small asset managers, and specialty finance. We've invested $4 billion over the last 28 years across 8 funds. One of the benefits we've had of specializing is that our funds have had very few losses. So let's go to our first topic. And Ian, let me start with you, if I may. How do you differentiate between various funds in the middle market? Are you finding returns are going up or down? Are you seeing anything that produces better returns?
Well, listen, big picture, we differentiate funds by those that add value to their portfolio companies and do it in a repeatable way. Different firms have found different ways to do that. For a Verona Stewart Stevenson that was just up here, historically a big part of that answer would be buy and build. They have a platform company. They do 3 to 5 add-on acquisitions over the life of it. It's demonstrable value, and it's a repeatable process. For a Guardian Capital Partners, which is a fund I invested in earlier this year, their answer would be we're buying companies with EBITDA less than $10 million. We are diversifying them and growing them above $10 million, making them much more attractive to a different universe of buyers. So you want to be in that bucket of GPs that really add value, and you want to be able to articulate how you do it and show that it's repeatable. In terms of whether returns are going up or down, that might be a better question for Hamilton Lane or for Josh Lerner. I'd say though that the broader PE market trends are not as important as manager selection. So we're all out there trying to find the first and second quartile managers, because the top quartile is always going to make money. And if the top quartile doesn't, we're in an economic picture that's we all have bigger problems. That said, private investment is subject to cycles as well. I think we all are kind of looking around saying, how are these firms that are buying things at 12 times with 60% equity contribution going to make a return on that equity? So, as a GP, I have a lot of respect for people who are selling into this market now and who are not relying on strategy of being the high bidder in every broad run process, and that's another way that people can differentiate is through their sourcing model.
So find good managers, beware of pricing. Whit, want to add something to that?
Yeah, he gave me a lot of great points and couldn't agree with him more. I think that the two things are being able to really articulate kind of what your strategy is and what you've done historically and why that works. And I think the other term you used is repeatability. Can you do what you've done historically? Because it's really easy to kind of show up at the door with a realized return profile that's 3x plus. And I think our jobs at the end of the day is really finding the groups that are able to do that on a go-forward basis. Charles, I think when you asked the question, you said, how do these groups differentiate themselves in the marketplace? I think as much as the panelists up here would like to think we're pretty smart guys, and everybody in the room probably thinks they're all pretty smart. I know some GPs certainly think they're pretty smart when they show up and chat with us. This is a relationship business. This is a partnership business, and in a lot of ways, the playbook has been written on how to do these deals. And we're fortunate enough to have a plethora of investment opportunities to look at in any given vintage year. Given that these are 10, 15-year relationships, for our perspective, the quantitative analysis that we do, that's terrific, and I think that gets you in the door. I think there's a lot of folks that are generating returns, but if we're going to have to be together for 10, 15 years, that's where the relationship element comes to fruition. For us, I'd say that's the differentiating factor, and you can't put your finger right on it. But I think you know it when you see it, and it's a trust business, it's a long-term business, and I think we put a lot of value in that.
People matter. I wonder if I could ask the panel to move their microphones a little closer because they're recording this, and I think they can hear in the room, but they may not be able to pick it up on tape. Arslan, how would you assess the current fundraising market, the current fundraising in the middle market? How do investors approach a market where some number of GPs desire to move up market, if you will, get bigger? What are your thoughts there?
Yeah, so the observation we have in the market mostly comes from, so we have a huge database, and over the years and through an acquisition, we've ended up with 350 different unique GP relationships that equate to 500 different funds. So you can call it as a quasi proxy to what's happening to the broad market or what's happening in that huge portfolio that we're managing and we're tracking in our databases. So the way we've seen it develop over the last few years is, I think it's a very binary world right now, the way we see it. The successful middle market GPs often don't even formally fundraise, and their funds are either fully committed or oversubscribed before they even print the PPM. The ones that are not as successful, and we can talk about the differentiating factors all day long here, but ultimately I think what we all rely on is these GPs being able to produce returns on a consistent basis so we can go and return that capital back to our investors and the pensioners who are relying on us to put the capital to work in a smart fashion. Those who are not delivering are taking a very long time to raise capital. Some of them are even in the market because that's the direct answer to your question, Charles, is how do we see the market today? Successful guys are very successful in raising capital. It's taking them less time to raise capital than it may have done in the past. They're able to raise more capital than they have in the past. Because I think what the LP world, in our view, has finally gotten is the discipline of not just giving people mulligan after mulligan after mulligan. What we did see in the venture industry, for example, for a very long time, and we had a whole decade of no returns in that industry, and yet LPs kept giving all the VCs that should have gone out of business, by the way, long time ago, capital. And finally, some of those funds are winding down. So what we do see is, if I were to summarize what I just said, a very binary market for successful GPs being very successful in raising capital, and LPs getting more disciplined around holding the GPs accountable. I think that is a sea change in our industry that we did not see a decade ago. LPs would not hold GPs accountable to the point that we hold them accountable now. And the reason for that is that, A, we all have more choices now, and to Whit's point, I absolutely agree with him. There's a term we use in our team a lot, we call it substitutability. There's a lot of substitutability in the middle market space. So if there's a GP that comes and pounds on your door and goes, I have the most unique strategy that nobody has ever thought of, then be skeptical. Because I'm sure we've heard that story 20 times before. Substitution is there. And the successful, the second part of your question is, the successful guys actually do go end up and raising bigger funds. That is absolutely true in this industry. Guys that we see overperform at the $500 million fundraise, the next fund is going to be $1 billion, the next fund is going to be $2.5 billion, and to a certain extent, they vacate the space that they're good at. So part of the analysis I think that all LPs do, and we do a lot, is we make sure we do the attribution analysis on the size of deals that these guys were successful at, and whether or not those size of deals can actually fit in the new fund. Now, going up market in its own is not bad, by the way, because they can afford more resources. They can hire smarter talent now, because they were not able to afford some of that talent at a smaller fund size. But the question as an LP that you have to ask is, you don't want a portfolio of all $4 billion funds. You do want to have the diversification between middle market and a large market GP. And the last point I would make is, we actually did a study about a couple of years ago, coming out of the recession, to just look around the myth that, oh, is middle market a space to be? Is large market bad? And this and that. And quite surprisingly, we did not see the alpha that people keep talking about between the large market and the middle market.
Interesting.
So although there is that myth out there, at least the data that we looked at did not prove that the large market is necessarily a bad place to be in.
Interesting. So when Arsenal's looking for consistent returns and he wants to be careful about size, any thoughts?
Yeah, I think for us, size is certainly part of what we did, and I think we were all generally agreeing that most people were looking at is the funds less than $1 billion. We can come up with all sorts of reasons why that's a good place to be playing. I think we put the number on anywhere from 800 to 1,000 firms out there that kind of check that box. In a fundraising cycle, that means you've got 200-ish firms that are coming out at any given time. A couple stats I saw, we were kind of prepping for this panel, is there's 275 funds that closed last year. We're on track for 300 funds to close in the broader private equity universe this year. So to answer your very first question, Charles, the current fundraising market is infinitely better than it was 3-4 years ago. There are groups that are coming to market very quickly, and sometimes we can put our finger exactly on why that is and why they're able to fundraise so quickly and why they're successful. There's some other stories out there that we can't quite get comfort with, but I guess that's the beauty of this business. There's a lot of limited partners out there, and there's a flavor for everybody. What we've seen in our GP base is there's a large group that kind of do their pre-marketing, come out to us well in advance of formally fundraising. We talk over what fund size makes sense, and we have a really great dialogue where we're able to kind of triangulate on what the best go-to-market strategy is. I think the other part of the world is everyone else, and you use the term binary. I think that's right. There's guys that can fundraise and they can do it really quick, and if they've stayed in the lower middle market and the mid market and haven't got too big, that's terrific. The other bucket that I would throw a lot of successful groups into are the groups that do have a clearly articulated strategy. Their track record may not be as deep. They may have some team issues. To the extent those groups get a deal or two or three in the portfolio that we can put our hands on and that we can kind of touch and feel and really actually get a feel for not only what's going to be in the portfolio, so take out a little bit of the blind pool risk, but have a proof of concept point in terms of this is what they said they're going to do, and yes, they've actually done it. So we kind of see both those, both those ends of the world from a fundraising perspective. Resources are kind of finite in all of our various shops, so you do have to kind of force rank the opportunities that are out there. And so to my stats on kind of the number of groups that have come out lately, I think 2011 was probably slower than we all would have expected. 2012 started to pick up. 2013 and the first half of 2014 have been very busy. And we've just really been forced to kind of think hard about where we throw resources and kind of what we prioritize in terms of where we put our dollars.
Great, thank you. The only thing I'd add to this is that in our funds, we've kept our fund sizes relatively small and consistent, absolutely at the behest of our limited partners. There's a cost to it. We've got a couple of investors that really want us to be bigger, and several can't come in because we're too small, but generally our sense of our partnership base is try to stay at a reasonable fund size. Whit, let me come back to you here. How about some general comments about fund competition? What do you see playing out in the middle market right now? Do you find the market's becoming more efficient, or what would you say?
I think it's certainly more efficient. I think if you just look at things from an absolute perspective, and this is purely anecdotal, and Josh and I are going to get on the specific stats, but I think if you looked at top quartile returns from the late 1990s, early 2000s, and you look at the more mature funds that are out there today, there's a ton of cyclical reasons that you can point to this, but there's almost 400 or 500 basis points of outperformance at that top quartile number. And I do think a piece of that is the market becoming more efficient. Like, competition is certainly increased, and we're seeing it in the middle market and the lower middle market. So I think you'd be naive to assume that in most of the lower middle market that you can really find somebody that can truly generate proprietary deals on a regular basis. Do we feel that there's groups that can generate advantage deal flow? Yes. And I think that's what we're going after at the end of the day. We're not doing deals so small, for the most part, that they are going to be truly proprietary. Every GP that's going to come through our doors is going to tell us why they're generating proprietary deal flow. And that's great. And I think as long as they have an approach to differentiating themselves from a deal flow perspective, and an approach to differentiating themselves and winning deals, because that's really what it comes down to. It's less about the actual deal flow, and it's more about the deals that you do. So I think back to your original question, I think the market is more efficient, but we certainly think that there's a lot of opportunity out there. And the last thing I'd say is, at the lower end of the market, to the extent that you can buy right. So there's the easy anecdotal, purchase multiple analysis out there. If you went from the large cap guys to the smaller cap guys, maybe you can buy it 1.5 times cheaper. That's great. So that inherently helps. So I think as you move lower and lower in the market, where you do start to see that advantage deal flow, it's another opportunity to buy right, and that certainly kind of helps you differentiate, your fund as a GP out there in the marketplace.
Ian, any dissent? Market becoming more efficient, smaller deals, better pricing?
No, I certainly agree with Whit. It's definitely a more efficient market out there. Private equity in the U.S. is a mature industry. That said, I would say it's a mature industry. And I think that's especially true in the middle market. I see Chris Lund from Hamilton Robinson in the audience there. He would tell you that there are hundreds of thousands of companies in the U.S. with revenues from 10 million to 100 million, and 4,000 to 6,000 of those trade every year. So I think there's still plenty of opportunity in the middle market and the lower middle market.
Thank you. Arsalan, I want to ask you about focus funds versus general funds. When we raised our earlier funds, we found LPs were very excited and pleased that we were focused and had developed so-called domain expertise. But this summer, as we started raising Fund 9, we had a couple of investors tell us, quote, that they want to do generalist funds. So do you prefer generalist funds, focus funds? What are your thoughts?
I think in a diversified portfolio, Charles, there's room for both. Especially for, as I said, for a diversified portfolio where you can afford to make certain tactical bets around the edges, there's definitely room. And I was thinking about the way our portfolios are constructed. The two sectors where we have made those tactical bets on a focused strategy are energy and financial services. The reason why those two, because just from a sheer sector expertise point of view and the size of industry point of view, those two naturally lend themselves to have industry specialist funds. The third one that comes to mind is healthcare, because it is such a big part of your GDP. We do have one or two specialized healthcare funds as well, so I put that in the bucket. Healthcare, financial services, and energy. Energy itself is such a deep and diverse asset class in its own right, that people have real assets, people have infra, people have middle market, upstream, that you may end up with a specialized industry-focused GP. My advice, though, would be for LPs who are entering in the private equity asset class for the first time and who are looking to buy diversified portfolios, making those focused sector bets could be tricky, could add a lot of volatility in the portfolio, so you do want to go with some generalist funds. And whether or not recently people, I think would, and I think we spoke about it when we were getting ready for this panel, there have been a couple of sector-specific funds, which is probably the noise you were hearing, Charles, who, when we went through the global financial crisis, took more of a beating than the more diversified funds. And that's what the LPs are looking at as those who've been burned by sector-focused funds who did not perform well and performed really, really poorly in the downturn because of the sectors they were focused in. Is diversification good in that kind of an environment? Yes. But my starting comment was, if your portfolio itself is diversified and you do have one sector that goes through a really bad cycle, it's not going to kill your portfolio.
It's interesting you mentioned those three industries, because two common denominators in those industries. One, heavily regulated.
Yep.
Two, the accounting is really arcane, so you kind of need to be steeped in it, or it's
complicated.
It's complicated. Follow-up comments, Ian.
Well, we're not against generalist funds. In fact, we probably lean more toward generalist funds. In reality, I think most funds these days have a few verticals that they specialize in, which gives you what I will call a diversified specialization, right? You know, I think we heard from Josh Lerner this morning that you get in trouble when you have people who are sector specialists who then try to branch out and be generalists and do things outside of their bailiwick. But you know, there are also certain sectors where I think you'd be very foolish to go without a very specialized river guide, like investing in banks or healthcare or real estate.
Thank you. Well, I want to thank the panel here. I was determined as the moderator to get as many thoughts as possible out there in 30 minutes, and I think you three gentlemen succeeded, so thank you very much. Any other questions? I'm watching this red clock goes on us here. Okay.
Charles, and Wick correctly pointed out, 10 minutes were stolen away from a 30-minute panel.
Oh, that
So we
panel in
finished
front
it.
of us. What were you guys doing?
We were catching up on the last panel, I think. So, but that's fine. You're right. If there are any questions in the panel, we're happy to answer.
Do we hear from anybody? Any panelists want to ask?
One question I did have is, and I don't know if Ian or Wick, you want to take it, is how do you guys actually define middle market? We spent the last 20 minutes talking about it. There are so many different definitions of middle market. And I've heard the sub-billion dollar, but I've also heard the argument that it should actually be based on the size of deal the GP is doing. So some call it $1 billion, $1.5 billion enterprise value deals. If a $1.5 billion fund can do deals less than $1 billion, then it should be a middle market fund.
I think from an EV perspective, we've kind of used the two kind of deal size for mid-market. I would argue lower mid-market perspective, the majority of our time, you know, that threshold's 100, 150 million from an EV perspective. I think practically from a, you know, given our structure, you know, as a fund of funds and how we kind of legally construct something around how we're going to capture more middle market, you know, we did an analysis of all the funds out there. And so the bright line on fund size is the easy way to do it, but in no means does fund size necessarily dictate, you know, what part of the world you're actually playing.
Ian, different view?
You know, a year or two ago, or maybe 2 years ago, we would have said middle market are funds that are 150 million to 750 million, and they're doing enterprise values roughly a third of their fund size. Now I would say we look at it much more broadly, 100 million fund to $1.5 billion
Arson, do you want to answer your own question there?
No, I think we probably rely more on the size of deals than the size of funds. So
Okay.
we do have a broad definition on the size of funds, and we rely more on the types of deals that the GPs are going after. And I think the way that we describe it, and within the middle market, we have two layers. We call it the lower end of the middle market, where it's deal sizes from 100 to 400. And then the upper end of the middle market, where the deal size can go up to $1 billion enterprise value.
Like them equally, or any thoughts?
I think so word of caution, the small end of the middle market can be really, really tricky. Because that's where you will have losses, that's where you will have volatility, and that's where you need to be really careful. I think that volatility goes away as you go up market with slightly bigger deals. Because these small fledgling companies may only have one or two big customers, and if one of those customers decides tomorrow I'm going to bring in a supplier because you're becoming too big for me, your company will be gone.
Questions out here?
If no one else has a question, I have one final question. We're hearing a lot about specialization and, in particular, energy and financial funds. And within financial in particular, as you hear more people talk about energy, what do you like or dislike about financial funds?
Well,
I think that's for Charles.
I live this every day. I'll just say that one big attraction today is valuations. The clock's been rolled back 30 years. We're investing right now at 90% of book value. The U.S. public equity market is at 270% of book value. These gentlemen can tell you deals have been done in the last year in the LBO world at up to 12 times EBITDA. We're investing at 12 times after tax depressed earnings, because financial services is way below its historic run rate right now. Deposit premium, this is kind of an inside baseball statistic. We're investing at 0 deposit premium right now. We're buying under book value. We have companies being taken over at an 8% deposit premium, so there's some very attractive big spreads right now. Profitability in financial services is depressed right now, but consolidation has picked up. Mergers have been very, very active in the last year and a half. No mergers from 2008 to 2012. We've had 26 portfolio companies involved in the last 20 months. Different views on Arsenal?
So I think that's absolutely spot on financial services. The other part of the question was energy, so I could spend maybe 10, 15 seconds on energy. The reason why we like energy a lot is, I'm sure all of you have heard about the shale, so I'm not going to bother you with that. But the derivative of what's happening in the US impacts many different industries that are coming out of the energy industry. So petrochemicals, for the first time, as Charles just mentioned, we're back 30 years in the past where financial services were. We're back 50 years where US at one point was one of the cheapest sources of petrochemicals in the world. We're almost there. We're not there yet. Middle East still is the cheapest, but the amount of hydrocarbon that we have, and we're really fortunate that in this country we have it, I'm pretty sure in the next few years we could be going head to head with the Middle East in petrochemicals, and infrastructure need to move that energy from where it's being discovered to where it needs to go is huge. I think I've seen all kinds of numbers out there. The need to build infrastructure to support the energy build that's going on in this country is $1 trillion to $2 trillion over the next few years. Private equity still is a small drop in the bucket of the need for capital. Energy is a very capital intensive. So is financial services, by the way. They're both capital intensive industries. And there is a lot of runways. I don't think it's a bubble. That's what you worry about when industries get hot, is there's a bubble like the internet bubble in the late 90s. Energy, I think, has legs, and it has legs that will go on probably for the next 10, 15 years. And private equity the smart guys should make a lot of money investing in this industry because it's here to stay.
You've used a good term, because we have a similar thought about runway. We don't think industry profitability financial services is back next year or the year after year with a zero bound on interest rates. You've got depressed margins, you've got lending spreads of collapsed. But we think over a 10-year period, there's a lot of very positive tailwinds. You doing anything in energy financial services? Anything you want to add?
We took a long, hard look at the energy space and agree with all tailwind comments and long-term But I would say that the infrastructure opportunity, in terms of the domestic infrastructure build out that we need, I personally think it's just a tremendous opportunity in the next handful of years. That said, there's been a lot of capital raised in the energy space, and much like the rest of the private market right now, prices are getting fairly robust.
Ian, Hartford's a pretty big investor. Are you doing anything in one area or the other, energy or financial services?
We actually don't do as much in financial services because we are a financial company. So we're looking to fill in the rest of the puzzle there. We're looking at energy. I agree, certainly long-term trends. I think that for a stodgy insurance company investor, there remains some commodity risk worries and even some technology risk worries at this point for us to get too specialized and too far upstream.
Hal, thank you again. Really good.